It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and wow, do I have a lot of stuff to talk about today. So I think the first thing we want to hit on is let me share some thoughts, questions, things like that I've had for some folks I've met with recently. I've been fortunate that I've had a number of different folks reach out to me, and that's awesome. Like I said, you can always do that at yourpersonalbank.com if you want more information. The personal bank concept, like I said, it's quite straightforward. It's not that complicated. And the bottom line is it's really all about positive arbitrage. Now, a lot of people, get, how should I say this? A lot of people get hung up or think that positive arbitrage, it kind of stops in their tracks because they think that that's a complicated concept. And frankly, it really is not. Positive arbitrage, all it means is that you're earning more on money than it's costing you to use it. Banks, for example, are a perfect example of how they operate. I mean, think about this. Most people understand this, that banks take deposits from you and I, and they pay us an interest rate on those deposits. Now, these days, of course, why I'm laughing is the interest rates that they're paying on like checking and savings accounts and things like that, money markets, extraordinarily low, and you can thank the Federal Reserve for that. But, maybe you might get 1% if you're lucky these days on those types of accounts, as most of us know. And then they take that money and they loan it out to people for, car loans, home loans, various things like that. And so today, if somebody has good credit, they can get a home loan in the 3% range, a car loan's 5% range typically. So the point is they're taking our money and then loaning it out and making the interest on those loans, right? And they're keeping the difference. So for example, if a bank does a car loan and they charge the borrower 5% for the car interest rate, and then they have that money. The money they used was used from deposits like checking, savings, money market, and whatever. Let's say they're paying 1%. Let's be generous. They're keeping the difference, or the 4%. And that's how banks operate and have, forever, right? That's how they make a profit, okay? Well, your personal bank concept is really built on that same idea of setting up a high cash value policy to maximize dividends, not death benefit, dividends. And we have companies, like I've been sharing repeatedly with folks, that have been paying 5, 7, 5, 6% dividends, even today, even in today's low interest rate environment, have been paying those dividend rates or higher for, last 25 years. I'll show you the charts, and never missed a dividend since literally before the Civil War. I met with a couple clients today, and I was sharing with them that I did a show a while back where people looking for dividend returns on dividend-paying stocks and bonds and things like that. And I'm like, why? Why not look at it dividend-paying insurance companies? Because they're the granddaddy of them all. They've been paying these dividends through literally the Civil War, the Great Depression, both world wars, you name it. And they're well-positioned to continue to do so. They're A+ rated, tons of cash reserves. And one of the companies I worked with has already come out and stated they're going to keep the same dividend rate. Theirs happens to be 5.75% next year, 2022, and probably 2023. And when I shared that with these folks, this one gentleman, he's very, very successful person, he stated, he goes, wow, that's impressive, particularly in today's interest rate environment. He's right. So we got these high dividend paying insurance companies, policies. And then we set up a bank line of credit using the cash in the policy's collateral, and the difference is what you earn when you access the funds. Look, it's quite simple. If you put the money in there and earn dividends, you're going to get the dividend, right? So if it's 5, 7, 5, 6%, whatever, that's what you get. And by the way, that's insured. There's guarantees, and we can set it up so it's tax-free, so that's powerful. But then when you access the funds, if you want to use the money for, whatever reason, doesn't really matter, you can access those funds from between 3 and 3.95%, depending on which bank we work with, which depends on, the size of the account and such. And the point is simple. When I ask people, if you're earning 5, 7, 5, 6% dividends, say, and then you access those funds from the bank line, and you're getting charged 3 to 3.95, what's your money doing? The answer is quite simple. You're earning 2 to 3% positive arbitrage. And by the way, that's been a historical example. One of the companies shared with me that the positive arbitrage has been in place every single month for the last 40 years, except for 2 months. And those 2 months had happened to be equal, so you weren't getting hurt. So my point was simple. If you're getting positive arbitrage on money that you've spent or allocated elsewhere, aren't you making more money? The answer is yes. You're getting your money to work for you further, faster, longer, all that stuff. So it was very interesting, very and kind of fun for me. Like this gentleman said, who's again very successful, said, "Wow, you've got something here." I said, "Thank you. I know." And that's why I've been sharing with the show and all that. And he goes, "Look, he even stated himself, look, if you can get any kind of positive arbitrage on money, that's just extra money in your pocket." And I'm like, exactly. And like I said, that's the business model, the main way, how banks operate and make a profit. So he asked me the question, what do you call this? And I said, well, I call it your personal bank. And the reason is quite simple. Kind of came up with it. It kind of happened along the way. And as I explained, I said, look, I was explaining using the policy to grow dividends, access the funds to the bank line. And I said, you're operating like a bank. And one day I said, it just hit me. I said, it's like your own personal bank. And that phrase kind of stuck, and we've used it. And now, that's our website, all of that. That's how we're branding it, if you will, because you're operating like a bank. Now, again, with your personal finances, business, whatever that may be. Why is that so important? Well, do you think banks are successful? Are they savvy about money? Can we learn and operate? If you learn to operate like a bank, is there anything you can learn from them? I think the answer is pretty obvious. Yes. So again, a lot of the questions that come up about this, it's so interesting. I find that a lot of people, they're like not familiar or didn't realize. I get that answer or that response quite often. They're like, wow, I had no idea these companies have been paying these kind of dividends, still are, and have been doing so for so long. I know it's like they've done a terrible job of advertising this. So that's part of my purpose of sharing these ideas, so people know, look, there's another alternative. There's a way out there. You can earn good dividends, solid, consistent dividends, long-term, on a tax-free basis with guarantees. Oh, and then by the way, on top of that, you can then access those funds to invest or pay bills or supplement retirement or whatever it may be, and use those monies and still earn some interest on it. Because even a comment thought, well, at this meeting I had, two gentlemen, they were talking, and he said, well, I could take the money and put it in the market or invest and all that. And like the other gentleman said, well, yes, but you are, of course, taking on risk, market risk and various things. Here, you're not. You're reducing taxes. Again, you can grow the money, access it, and pass it on to yours tax-free, okay? If we set it up properly, which of course we do. And I said, yeah, and think about this a minute. I said, I've shared this thought with people so many times. You could, if you really want to invest in the market or real estate or cryptocurrency or precious metals or anything else for that matter, or a business or whatever, you can certainly take monies and do that. Or you can take those monies, put it in a personal bank policy to earn dividends, and then access it through the bank line of credit and pick up 2 to 3% positive arbitrage. Even if that investment, I made that statement, even if that investment went kaput, it did nothing, just flatlined, which hopefully, obviously, that's not the desired result. But even if the investment did nothing, you're still picking up 2 or 3%. And if the investment did work out like you anticipate, let's say you're making a 7% return or even a 10% return, like I shared today. If you're making a 10% return and then you add 2 or 3% positive arbitrage to that by using the personal bank concept, you realize you're increasing your rate of return by 20 to 30%. Folks, that's huge. You take that and multiply that over time, compounding. The difference is, like you said, it's huge. I mean, if you're going to invest, you have two investments, and you're looking at one, and the expected rate of return is 10%, for example. And the other investment is 12 to 13, same risk tolerance, same everything, but the rate of return is higher. Where are you putting your money? And that's why I tell people, call me toll free 866-268-4422 or at yourpersonalbank.com. I'll share with you how you can create this positive arbitrage to increase your rate of return. Why is that so important? Well, certainly most people understand if you have the opportunity to increase your rate of return without adding on any risk, it's kind of, it's just a no-brainer, right? It makes sense in most cases, right? Also, if inflation kicks in, we're going to need our money to work for us more. It's going to have to accomplish more, grow more to get the same effect, same result, same return, right? Net effect after inflation. And if taxes go up in the future, like many people think they will, our current administration is talking about it constantly, having a tax-free bucket is just a wise diversification strategy. So there's so many different reasons, like I said, to look into the personal bank concept. It just makes sense, like I said. Again, you can contact me at toll-free 866-268-4422 or yourpersonalbank.com. A few other thoughts, and I want to touch on here. They were brought up recently with different folks. Is one of the questions was this positive arbitrage thing is really cool. What about the historical? I shared that earlier. Last 40 years, every single month, positive arbitrage has been in play, except for 2 months out of the last 40 years. So, and those 2 months, they happen to be equal. So you literally have a positive arbitrage situation. Another couple of thoughts came up with this meeting that was interesting. Like the gentleman asked me, he says, well, I have a couple of policies that I've been funding for some time. I have some cash in them. Do you just fund new policies or you work with existing ones? And I said, we do both. In other words, we're going to look at his existing policies, the cash policies, and I said, look, I can show you how to maximize the cash growth on them, all right? And so maybe make them more efficient than they are now, even right now. And then secondly, I said the problem most people have when they have a policy with cash in it. So if you have one of these, this is going to be very important. If you're going to access it, take a policy loan like most people do, the insurance company charges you interest. And oftentimes the interest they charge you is as much or maybe even more than the dividends you're paying. So like his case was exactly that. And so you can access money from it, but it doesn't do you any good. Your money stops growing then, right? So how can we fix that problem? And the answer is yes, we absolutely can. Stay tuned in the next segment and I'll share with you exactly how we can do that.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And, we're talking about various questions that have come up with folks that I met with this past week. And one of them I was alluding to in the last segment that was very interesting was the gentleman asked me, he says, well, this is very interesting. I like the idea of being able to get positive arbitrage. In other words, earning interest on money that I'm accessing and using for other purposes. And he's a very successful gentleman and was looking to invest in various things. And he's mentioned, he goes, do you work with just setting up new policies to maximize dividends, or do you work with old ones? I said, both. So one of the things that, which of course got his interest level even higher, because he goes, look, I have a couple of policies that I've been funding them for a number of years, like he said, and there's some cash values in them. Can you work with those and help me? And I'm like, absolutely. So here's the thing. What if you have one of these policies you've been funding maybe and it's built some cash? The problem is for most of them out there is you have cash in there and it's available, and you can typically take it through either a cash withdrawal, which is typically not recommended because you reduce your cash value and it could cause a taxable event, by the way. So the better way, generally speaking, most people agree, is you'll access it through a policy loan. Now, obviously, that eliminates the tax on it if it's set up properly, and the dividends continue to grow, right? In the policy, the problem is with most of those is that yes, the dividends continue. You continue to earn dividends on it, but the interest rate that the insurance company charges oftentimes is the same or even higher than the dividend you're getting paid, especially today. So what ends up happening is, yes, you're accessing funds. Your policy is still growing dividends, but the cost of borrowing offsets the dividends or even puts you underwater a little bit. So it might even cost you to take the money. And so your money stops growing for you is what it really boils down to. So I said to him, well, I've got really, really good news for you. I'm going to show you how to unlock the cash values, unlock the liquidity in this policy so you can use it and still earn interest on that money going forward. Well, he was all ears. Obviously, we're setting up a bank line of credit, and the bank is charging less than the dividends earned. In most cases, that's true. So I said, first we want to do is look at your policies, where they're at. Are you funding them or you're not funding them? How much cash is there? Is there anything we can do to tweak them, which many times there is, to enhance the cash value growth? Okay, so I often can help people enhance or improve their existing policies, right? And then we set up the bank line, and in his case, he was earning, he's earning about 5.8, and the other one's about 6% dividends on it currently. Still, good companies he's working with. He's had these for 20 years, I think he said. And I said, I can, based on the amounts he had and such, I said I can set you up with a bank line of credit. They'll charge you 3% on these when you access the money. He's like, if I'm making 5.8 to 6% interest, or dividends, I should say, and I access it through the bank line, I'm making 2.83% interest on this money still, the difference, the positive arbitrage. And I'm like, exactly, you got it. I said, invest that money in anything you want. He's like, yeah, now I got to go find something to go invest in to make some money. I said, exactly. He's like, well, can I put whatever you want? If you want to invest in the market, great. If you want to invest in real estate, awesome. Cryptocurrency, precious metals, a business, or anything else for that matter, go for it. If you have some bills or debt, fine. You could do that, or you have something you want to purchase. You want to buy a car or whatever, or a house. I have people that do that. I've shown people how to free up the cash in their policies and still earn interest on it, and they've gotten built houses or bought houses, okay? So my point is simple. Much like real estate, a lot of the times for a lot of people, they have equity in their property, right? But oftentimes you've heard the term, it's locked up. The equity's locked up in the bricks and mortar. There's no way to access it really, unless you get a loan against it. You can get a loan against it. The problem is it works as long as the value of the property increases faster than the interest you're being charged. Now, the last number of years, that's been true. But, of course, as we all know, that's not always the case. In fact, with real estate, 0809 taught us a lesson, many of us, that real estate values can drop, right? They certainly can drop. So that's not a guaranteed way, certainly, of making sure your money is, of getting positive arbitrage is what I'm trying to say. And the problem is with real estate, not that it's a bad investment or anything like that, you don't know year to year what its value is going to increase. And that can vary widely in the location you're at and all those kinds of things, right? I would say with real estate, it's location, right? So one person's property could increase 10%, for example, and someone else's could only increase 5% or not at all. And it could be in similar areas, but because of the type of property it is or whatever, it can be vary widely. You just don't know what the appreciation is going to be, right? Well, the advantage here is if you've got a dividend where the long-term historicals are paying 5.75 to 6% dividends, and that's on the low end, and and the banks charge less than that, and that's been a long-term positive arbitrage scenario, certainly for the last 40-plus years, you have some certainty that your positive arbitrage is going to be there in place. That's much, much more powerful than, say, borrowing money from a property with an uncertain appreciation rate. You see what I'm saying? You get some certainty there. And that's one of the nice benefits of it, okay? So the other thing, and like I said about this, is thinking in terms of another way of attacking. There's more than one way to skin a cat, right? So another way to look at this, and I've talked about this on a couple of shows briefly, and I'm bringing this out more and more because more and more people are asking me about this question. They're like, well, what if I borrow some money through a line of credit or whatever. A lot of people can borrow money today, especially at very low rates, guaranteed low rates. And what if I took that money and invested it into purchased a policy to get the dividends? Well, does that work? And the answer is yes, absolutely it works, as long as the dividends rate you're earning is higher than the borrowing cost. And today, especially, I have a lot of folks where they're borrowing money in the 3% range and earning 5.75 to 6% dividends on a tax-free basis. What's happening? You're picking up the positive arbitrage. You're earning the difference. You're keeping the difference, right? So maybe you don't have some cash laying around or liquid assets or funds you can allocate to this at this point. Or you have some, but you don't want to sell them or disperse them or whatever. You don't want to use those funds for whatever reason, but you have the ability to borrow against them, or you have an asset you can borrow against. I mean, certainly if you have an asset, I have a bank that'll do lines of credit against just about any asset you can think of. I mean, they've borrowed against antique cars, jewelry, you name it, anything of value, and borrow at very low rates, interest rates, right, to then take that money and fund a policy to get a higher dividend with a consistent, steady guarantees type of rate and tax-free and all that fun stuff. And now you're basically taking a illiquid asset or equity in bricks and mortar or whatever that may be, right? And now you're taking that equity, that asset, and turning it into a positive interest situation to create an income or supplement retirement or anything else for that matter. So it's very interesting how this can be attacked, or you can attack this from different angles and accomplish the positive arbitrage. Stay tuned in the next segment, and I'll share a couple other thoughts that, well, maybe you haven't thought about and how this could work and benefit you.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and I'm covering some questions and ideas that have been asked and bantered with some various people I met with this past week, in fact, and some of them are very interesting, and one of them that came up, actually, I want to touch on, was, about, it's a question I get a lot, is why isn't my financial advisor, CPA, tax attorney, whoever, brought this to my attention before? And like I said, there's a number of reasons behind it, but probably the number one reason is this is very much an area of specialty. As I stated, there's a lot of doctors, right? There's not many brain surgeons, all right? So I'm going to use a personal example. I had an accident where I was bucked off of an e-bike. It's an electric bike, I should say. And as I was going from a gravel to a pavement situation, and as I did that, the motor kicked in, the chain popped off, and the seat dropped. And so literally it was like getting bucked off a horse. I trained horses when I was a teenager growing up. It was literally just like that. I'm riding along. Next thing I knew, I'm just boom up in the air flying and landed on concrete and slid a while and, broke my right wrist in 3 places. And so, once it was determined, I went into urgent care and determined that, yes, indeed, the wrist was broken. And it's the first time I've ever broken a bone, thankfully. The doctors have asked me, how'd you go so long without breaking anything? I mean, I played sports. I played Division I rugby, for example, in college. Soccer, football, all those things. I've just been very fortunate. I sprained a lot of things, many bumps and bruises, but, never broke anything. And so I guess I was past due, right? Law of averages. Well, anyway, so the first thing I did, knowing that, I'm going to probably need surgery because it was, like I said, pretty messed up. So the first thing I did, I think anyone would do, is I reached out to some medical professionals that I knew, and I said, they basically said I needed a good hand surgeon. So I understand this, we all understand this from a medical standpoint. Not every doctor is a surgeon, but I needed not only a surgeon, I needed a hand specialist really to do this and do it right. And interestingly, my chiropractor and another gentleman I work with who's He does rehab work with a lot of professional athletes, actually. Both of them do. And they both recommended the same hand surgeon, and both said to me, this is the guy. And that's the guy you want to, that's who you want to go to. And so I did. He did a great job. It's healing. I'm doing well. I've just started rehabbing it, and they're very pleased. And, I've been assured I'll have 100% use of my hand again. And given that it's in my right hand and I'm right-handed, that's pretty important because I can't write right now. I can barely type, right? My point is simple. I'm trying to drive at is when you need something specific and special, I needed a specialist. I needed a hand surgeon. I wanted a hand surgeon to do the job right. I could have gone to any surgeon. He probably could have done the job, right? But I wanted it done right. I wanted it done by somebody who's experienced, one of the best. And so I shared this little story. I was meeting with these two gentlemen who were very successful. And, I'm sitting there with a cast of my arm, obviously, a removable one, thankfully. But they understood that. I said, if you're looking for somebody to suggest stocks, bond, mutual funds, diversify, or any of those other kinds of things, I'm not your guy. We all know there's plenty of investment advisors out there that specialize in those type of things. That's their deal. There's and there's a lot of good ones, and there's some that are not so good, let's face it. But if you have somebody you like, use them. And I said, here's the thing when it comes to investing. I'm totally agnostic about what you invest your money in. If you like real estate and that's your thing, I'm going to cheer you on and say go for it. If you like cryptocurrency or precious metals or you want to invest in your business or the markets or anything else, if it's working, go for it. And if you got a good situation, you have an advisor you like or whatever, awesome. I'm not going to get in the way is what I'm trying to say. Just like the hand surgeon doesn't get in the way of my primary care physician, right? He's there for a very specific job. I'm not changing physicians. I have a doctor, but I had a very specific need. And this is very much like that. I'm very much a specialist, and they understood that. There's very few people in this country that have the level of experience or knowledge that I do on using this concept. And I'm not saying that to brag or anything. It's just a fact. And they understood that, and that's why they wanted to meet with me. In fact, one of the gentlemen said, yeah, we should meet with this guy because he's been listening to him on the radio and seems to know what he's doing. You know what I'm saying? My point is, if you're looking to create positive arbitrage, don't expect to talk to just any old financial advisor and expect them to understand this. This is very much a specialty. And it's not their fault. It's like the primary care physician isn't going to know how to do hand surgery, right? But if you want to create positive arbitrage, I am the guy to talk to. If you want to reduce market risk and reduce taxes and those kinds of things, I can show you how to do that. If you want to increase your rate of return, I'm the guy to talk to about that. Stay tuned in the next segment. We're going to discuss this further, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Okay, welcome back. We're going to wrap this up, and I'll tell you what, the last segment, I broke one of the cardinal rules of radio. I said, hey, I'm a specialist. I'm the guy to talk to about this, and then I didn't leave you the way to contact me, so the radio folks are going to be upset with me. But anyway, if you do want to contact me, it's toll-free 866-268-4422 or yourpersonalbank.com. Sorry about that. But I want to finish that thought because I kind of ran up against a hard break, and I really did. Again, the idea of being a specialist. A lot of folks get the idea that, for some reason, a lot of advisors, that I'm going to step on their toes in some way or recommend something. Somebody's got a portfolio and they've been investing and they've been working with somebody and what they've been doing has been working. It's been successful. I'm going to be the first person to cheer you on until you keep doing it. If you're working with somebody and you're happy with them and it's working, by all means, keep doing it. If it's not working, obviously make changes. But again, I'm actually, what most advisors don't realize, I'm one of their best friends. I'm not antagonistic or a threat in any way because I don't do stocks, bond, mutual funds, diversify, options, or any of those, or real estate or any of those. by the way, I have a lot of personal experience with it. I can share some personal experiences. I've owned 4 businesses, and I've got a lot of real world experience I can share, but I'm not there to advise people. I can give recommendations or whatever, but I'm not there to like step on any advisor's toes. So if you have somebody you like and then you were working with and it's been great, keep them. Keep doing what you're doing. But what you're not doing, most cases, very, very few people I meet are doing this, is you're not creating positive arbitrage on your money. In other words, you could get your money to work further for you, work double time, so to speak, and increase your rate of return by picking up the positive arbitrage. If you've been listening to the show at all for any period of time, you've heard me say, you have a choice. You can take your money and invest it, or pay off a bill, or purchase an item, or you can put it into a personal bank policy, earn dividends, and then access the funds through the bank line of credit, pick up 2 or 3% positive arbitrage, keep the difference, and invest that money, or put it into purchase an item or pay off some debt. In other words, you're not changing anything. All you're doing is adding. It's like icing on the cake. You're getting an extra return on your investments, on your money, Let me give you another example from this meeting I had recently, this week. So, great example. I have this gentleman, he's like, he's got a big tax bill coming up. He owns several businesses, in fact, owns several restaurants here in town. And he's got a sizable tax bill coming up. Next year it's going to be due. And he said, I'm going to have to pull that money aside because I got to pay the tax bill. I said, well, when is that? I asked him roughly how much the tax liability was, and it was substantial. And I said, when is that due? And it's due in April of next year. I said, well, again, you have a choice. And both these gentlemen, as I'm sharing with them, understood this immediately when I shared this thought. I said, you have a choice. You can hold the money aside, and then when you pay the IRS the taxes that are owed, I have a question for you. When you pay that money to the IRS, will you ever see that money again? The answer obviously is no. In other words, will you ever earn any interest or benefit on those dollars ever again? No. He has the funds. They're set aside. They're designated to pay the tax. I said, you could do that. Give them away. Give them to the IRS, and you've given up control of them. Yes, you paid your taxes, which you need to do. But you've given up control of those dollars for the rest of your life. Or you could fund them into a personal bank policy to earn dividends, then access the funds from the bank line and pay the tax. And what would happen? You would actually pick up the positive arbitrage. And in his case, the difference would be it was 2.5%. Okay, pick up 2.5% positive arbitrage every year for the rest of your life. Which would you prefer? And I said, by the way, it'd take about 20 years. This gentleman's relatively, young enough. He'll be around 20 years from now, easily. Much longer than that, frankly, most likely. But I said, it'll take about 20 years, but you'll get that money back that you paid to the IRS in positive arbitrage. Would you rather have the money back or see it disappear forever? Well, that was a no-brainer, right? Then the next question came up, which was interesting because the other gentleman who I mentioned earlier, had some of these policies, had been funding them for a couple decades, actually, had built some cash value, and I'm going to show him how to enhance that and act, like I talked about in the last segment or two ago about how to access that money and still pick up positive arbitrage. And look, if you missed it, go to yourpersonalbank.com. You can check it out, any of the previously recorded shows. But he said, yeah, that would work, but he can't only fund so much per year, per month. It's going to take some time to build it up. I said, no, you can dump a chunk in all at once, a big chunk. He goes, really? I said, yeah, I've had people put in $1 million all at once. He goes, I had no idea that could be done. I said, most financial advisors, most insurance agents even, don't know that either. Or they shy away from it because they don't really understand how it works. And you'll hear them talk, well, don't do that because it'll become taxable and things like that. Here's the thing. Just because an IRA or a 401k is taxable at some point in the future, should you not do it? You could say the same thing about an annuity, couldn't you? Should you not fund an annuity or a 401k or an IRA because there's future taxes on it? Well, no, obviously not. That's a silly reason not to fund one of those types of financial instruments. Yes, you'll have to pay taxes on an IRA or 401k when you withdraw the funds. Most people understand that. And if you access monies from annuities, you're going to have to pay taxes on that down the road when you access it, right? Why do people fund IRAs, 401ks, and annuities? Other reasons, right? And by the way, they want to grow the money or what, there's many, want to supplement retirement. There's all kinds of reasons for funding those types of accounts, right? And by the way, frankly, not doing something, you want to understand the tax consequences of any investment, right? By the way, if you sell a property, if you invest in a stock or a bond or a mutual fund or a piece of real estate and you later sell it, typically you're going to have taxes on that, right? In most cases. So should you never buy real estate or stocks or bonds or mutual funds because they could be taxable in the future? No, that's silly. You want to understand the tax consequences, but to not do it because it's going to be taxable down the road, that's just plain silly. Okay, if it's a good investment for various reasons, then you do it, right? So my point is, yes, the gains could be taxable in the future, but what if you could pick up the positive arbitrage and basically, in essence, get the money back? In other words, would you rather give it up to the IRS in this case forever, or would you rather pay the taxes that are due but pick up positive arbitrage the rest of your life? And like you said, I know you could fund it all at once. I said, of course, I do it every day of the week with people. I explain to them, help them understand what the tax consequences are. They may be different than funding something over time, but as long as you know what the rules are and it still makes sense, you go in with your eyes open. You see what I'm trying to say? It just makes sense. So you don't want to shy away from something because somebody says, you don't want to fund a MEC because it's taxable. That's silly advice. That's the same advice as saying never invest in any taxable investment because it's taxable. That's just plain silly, folks, if that's the reason. Okay? If there's other valid reasons for doing it, like this case there was, then it makes sense to do it. And he's like, yeah, that makes a ton of sense. He goes, I had no idea you could do that. And like I said to him, most financial advisors and insurance agents either don't know or shy away from it because they don't really fully understand the tax liability, or again, they've bought into this idea that just because it's taxable in the future that you shouldn't do it. Again, I stated this now several times. That's just dumb. All right? People would never invest in anything because it was taxable in the future, right? Just about everything. That's just plain dumb. So anyway, I don't know how else to put it. All right. So I think I've covered a lot of the questions and thoughts and ideas that have come up this past week or so with various folks. And like I said, I really do appreciate, I actually enjoy answering genuine questions people have when they're asked in a spirit of better understanding. I guess I have a heart of an educator. It's something I enjoy. Oh, one other idea. Yeah, so I shared, I'm going to share with, I had a client who actually I've been working with them for the past 7 or 8 years, actually, and their parents, almost a decade prior to that. And, of course, now with his mom's age, he's kind of, like he said, I'm the one primarily taking care of everything, which I completely understand. And I've met with both of them many times over the years. And it was interesting as I was talking with Joe, is his name, and we spent some time. He was asking some questions about his different accounts and different things. Like I said, he's been a client for over almost, we're approaching a decade. And he says, at the end, he's like, I'm so thankful for that. He's a retired teacher, very smart individual. But he says, I understand my accounts better now again than I did before and now he's had experience with these for like the past 8 years. And he says, I really appreciate you taking the time to explain this to me. And he says, you really do have the heart of an educator. And he says, I've always appreciated that. And in fact, that's why I decided to work with you in the beginning. I said, I consider that a very high compliment. I really do want people to understand what they are doing and at least understand the reasons why they're doing it. They may not understand all the intricate details of every moving part or piece. Some of my clients do because they really want to get into the nitty-gritty. But I'd say most don't understand every single detail, but they understand the bigger picture. And most importantly, which is what I want folks to understand, is they understand why they're doing what they're doing. See, I'm not here to sell you or anyone else on setting up a personal bank policy and a bank line of credit and getting positive arbitrage and all that stuff. What my goal is to educate you, to help you understand that there's a different way of thinking about money and investing, and in many cases a better way, or a way to enhance what you're already doing. In essence, this is an improvement, right, on what you're doing, an enhancement. And if I can educate you and help you understand how this enhances your financial situation, it increases your rate of return, it reduces your market risk, it reduces your income taxes, okay? It increases your liquidity, it gives you positive arbitrage, which helps offset inflation and things like that. It puts you in a better financial position. What that does is I don't have to sell you on it, quote unquote, or talk you into it. You understand, and most of my clients genuinely want to do it then because they understand why. And most importantly, I understand, again, it's very much an area of specialty. Not everybody out there is doing this, okay? This is more uncommon than common with as Wall Street calls them, the retail customer. Wall Street generally defines a retail customer as somebody with less than 10 million liquid, all right? This is very common in the institutional investor arena, I can tell you that. We have our bank board meetings. We talk about these kind of things on a regular basis. It's very common. But in the retail world, according to Wall Street, it's not common at all. And that's why I do the show. That's why I educate people. But because of that, sometimes people get, they get into that syndrome. Well, if they don't do what everybody else is doing, you know what I'm saying? They get a little nervous about that. And I say, look, if you want to do what the 95% are doing, you'll get what the 95% get. But if you want to do what the 5% are doing, you'll get what the 5% get. And you see what I'm saying? I'm just showing a better way, a way to enhance what you're already doing. I'm not going to talk you into or talk you out of what you're doing if it's working. Now, if it's not working, that's a different story. But if what you're doing is working from a financial and investment standpoint, I'm not here to talk you out of it or discourage you from it. In fact, I'll be your biggest cheerleader. Frankly, I'm going to tell you, go out and make some more money. Keep doing it. Do more. If you got a business, do more. If you've got an investment portfolio, do more of what works. But enhance what you're doing and get positive arbitrage. Contact me at 866-268-4422 for more information, or yourpersonalbank.com. And again, that's 866-268-4422.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and bank line of credit rates may change. Contact yourpersonalbank.com for current rates.